This is not financial advice. I just hope you brought your oven mitts, baby, because it's about to get hot in the kitchen. And I hit that like button and show you, you know what? Don't invest in companies you don't understand and don't believe in, because if they dip, you not gonna buy the dip, and then you're gonna sell low and be right back here crying to me, and I'm not having that. You know what? Let's get straight to the point. Subscribe to the channel. And the first banger on our list is the one, the only AMC Entertainment, ticker symbol AMC. And at the time of this recording, it's currently $36 a share, baby. It's down 0.6 on a day. It's down 0.2 in after hours. However, it's up over 820% this year. Let's go. Now, you already know we got in this back when it was $12 a share, baby. But I want you to know this. There's been a lot of talk about the stock market and how it's going to crash after AMC runs all the way up straight to the promised land, baby. But guess what? You got to know how to make money on all of the stocks, even when they come down, just like we did. And it's a little example here just to show you that it's possible to make money on a stock. When BNGO came down from $6, boom, us on a Discord, we made a quick 20% on it. Now, if you want to be up on the plays early as we are, hit that Discord link in the top comment. We're going to welcome you with open arms. Now, what's going on with AMC, family? So, there's been a lot of people coming out and talking about what's going on with what is called the NSCC 2021-010 from the DTCC. Now, you may have heard about what's going on with this. You may have heard it referred to as a controlled squeeze, the government intervention, all of these kind of things, right? But this happens when a lot of people speak before actually understanding what they're talking about. So now, let's get straight to the facts, keep it real, keep it raw, like we always do. So now, the NSCC, they basically are trying to propose a rule to get a few things to happen. Let's break it down. Now, you got to understand what this is. The NSCC is this, the National Securities Clearing Corporation. And they let go of a 369-page document, and we're not going to go through the whole thing because it's not actually necessary. So pay attention to this. Who is the DTCC? They're the Depository Trust and Clearing Corporation. Now, they're at the top, right? So now, they basically have a organization called the NSCC, which is where they're trying to get this rule to go through. Pay attention to this. And why are they even doing this? Because I want you to understand that the clearinghouse, the DTCC, is on the hook if the short sellers, the hedge funds, can't pay us what they owe us during the short squeeze. So they don't want to be on the hook, so they're trying to ease the market so the market doesn't crash. They're trying to give it a different way. This is what this whole thing is about. Now, pay attention. They have basically $63 trillion, the DTCC, that they would have to use to help the hedge funds pay us, but they don't want to have to use $1 of that to help to pay us. So now, this is what they're trying to do. Pay attention. This is page 3 of this 369-page document. And it says, the text of the proposed rule change. Now, up top, we're going to start in green. It says, the proposed rule for the NSCC, again, the National Security Clearing Corporation, is proposing modifications such as this: to establish new categories for where existing members are permitted to sponsor certain new members to get into the NSCC and the DTCC group. So what's happening now is, you know how they got like $63 trillion under management and everything like that? They want to be able to add in more, so then they have the potential to cover even more in the event if they needed to do it. Now pay attention to this. This is in blue, close to the bottom. This is the most important thing that you've been hearing about. And it's this. They want to establish something, and this does not roll off of the tongue, but they want to establish what is called the Security Financing Transaction Clearing Service, also known as the SFT Clearing Service. Now, what is it supposed to do? This is where parties, or all of the hedge funds and everybody else who's a member of the DTCC, now what they're trying to do is they want to be able to exchange equity securities against cash. What does this mean? Long story short, the DTCC, they're trying to make a rule so that the hedge funds who are naked shorting the stock can have the chance to basically put up their Tesla stock, put up their Apple stock, put up their whatever kind of long-term position they have, and then get cash for it. So normally, think about this. If you have a stock, how do you get cash for your stock? You got to sell it. But if you sell it, imagine if you got to sell $100 billion worth of stock, or $10 billion worth of stock, or something crazy, so you could cover all of the synthetic shares. This would impact the stock market and bring it crashing down, and then it would have the SEC, which is like the government, on your back, right? But what they're trying to do instead is make something so, you know what? All of the participants in the DTCC and the NCSS or the NSCC, what they're trying to do is make it so all of them could basically say, you know what? You let us hold on to your stocks, your Apple stock, your Tesla stock, your Microsoft stock, and we'll give you the cash. So it's not technically like you're selling it, so you won't drive the whole stock market down. That's what this is all about. Let's pay attention to page 4 of this. And it says right here in green, the NSCC understands that the SFT will provide liquidity to the market and facilitate the ability of the market participants, like the short sellers, right, to make delivery on the short sales and to thereby avoid the failure to deliver naked shorts in similar situations. So now, what else is important about this document is this, family, right in blue. They actually acknowledge that naked short positions exist. Those synthetic shares that we've been talking about time and time again, they are actually being acknowledged. And the people in the background, the clearinghouses in the background who transfer the stocks from the buyer to the seller and so on and so forth, right? They transfer the stocks. So now, what's going on with that is they know that when they try to transfer ownership and tag it to your social security number or whatever is going on, that they can't do it. So then this is a fail to deliver, and they know how many there are and who is involved. So now they're trying to give the hedge funds a chance to actually basically put up all of their long positions and then don't crash the market down, because it's kind of like a pawn shop. You could think of it that way, where you go and you bring your ring or whatever to the pawn shop, and then you know what? They give you some cash. But you could come back with the cash later and get your ring back. You might have to pay a little bit more, but you could come back and get your ring back if you wanted to. But you have a timeline. So then it says this down here in red. It says on a typical business day, the DTC, an NSCC affiliate, processes orders up to like $150 billion in a single day. So what they're trying to do with this sentence down here is give you an idea of the amount of liquidity that can be offered to these hedge funds if it ever came to this extreme. So now, why is that important? Because at this current price, at $36 a share, this would mean that they could potentially cover over 4 billion shares of AMC. But notice, once the buying starts of billions and hundreds of millions of dollars of AMC, it won't stay at $36 a share. It'll go up. So this is why you hear them say the first hedge fund to cover pays the least. And now, that's super important, and shout out to them for that. But notice, if we go take a look over on the dark pool, we know even on the dark pool, remember, there's all of these shares. We can see what's on the dark pool. It's reported. So take a look at this. It says that the net position is down $5 billion, just basically, which means $1 billion in selling and then $6 billion in buying over there, right? That gives us that negative $5 billion, aka there's $6 billion in buying happening over on the dark pool. But if you look one up where it says 128 million, these are the amount of shares that have been traded over there, the volume of shares that have been traded over there in the last reported day. So now notice this is nowhere near billions of shares. This is nowhere near hundreds of or tens or whatever amount of shares, right? This is only 100 million shares. This isn't 700 million shares, 600 million shares. It's only 128 million shares. So now we see that there are other places that these synthetic shares can be. For example, like we talked about 100 times, VEQ Link, which is not reported to FINRA, and they cover 25% of all of the trades from retail investors, and then Citadel Connect, which does 47% of all of the trades from retail investors. So these can be where all of the shares are. Now, one thing I just don't have it on my heart to leave you uninformed, Robinhood, baby. Robinhood, their IPO is coming out, and they're expected to at least get out the gate. You might not catch this, but at $38 to $42. Now, you might not want to jump in immediately. They're getting a lot of bad press, but it could run. Because remember, the media, they want you to die broke. I tell you this 100 times. What do I mean by that? They don't want you to know how to make money on the stock market. So take a look at this. Barron's, they just posted this, and Barron is a really reliable source on the stock market. And they said Robinhood IPO is coming soon. And this is reasons to steer clear of the stock. They gave many reasons, but they said this is happening on Thursday, and they're offering up 1/3 of all of the shares, and they expect to come out with a valuation, total company value of $35 billion. Remember, this is happening on Thursday, family, next week. So now, there are many, many, many different analysts checking out on this, and then they said the problem with Robinhood is the quality and sustainability of their revenue, because 3/4 of their revenue comes from routing customer orders over to like Citadel or over to something like VEQ Link or Virtue Financial, something like that. They're routing the orders, right? So Now, they said, and I wrote this down here in green, it said payment for order flow is in the crosshairs of regulators like the SEC, who is the government, who is basically keeping an eye on everything like that. So now, if they cut off payment for order flow, then this could significantly hurt Robinhood in the future, baby. But again, if you can't handle the heat of these hot stocks, then stay out of the kitchen and consider investing in index funds, family. I love y'all. Take care.